What's going on, guys? So in this video, I wanted to talk about why I am personally closing my Starbucks position. As you guys know, that I've been a Starbucks shareholder for over a year now, and Starbucks is a company that I, enjoy as not just an investor, but also as a consumer. And so the fact that I'm closing out of my position here is something that is kind of counterintuitive to my ideas of saying having a long-term perspective on stocks. But due to the way that the management has kind of been running the company and kind of my analysis on what's going on with the company from a financial standpoint and how the company is funding all of their activities, I personally do not feel safe investing my money in a company like Starbucks. I'm going to be getting to that in just a bit, but this is also kind of a video that is more of enlightened based off of the information that I've been learning at university over the past couple of months. As you guys know, that I've really started to really open my mind to, kind of how financing works and how companies and individuals can kind of tweak the numbers that companies are reporting in order to boost their stock price. And I kind of think that that is what's happening with Starbucks. And that's one of the things that kind of made me really unsure about holding on to my position for the long term. Now, Starbucks, just full disclaimer, is a company that I do plan on owning in the future, assuming the company is able to kind of straighten out what they're doing with their balance sheet and their income statement. However, as of right now, though, the company is kind of steering the ship. I do not feel comfortable holding my money in, and expecting a larger return than the return I've already received. So in this video, I'm just going to go over that and kind of give a breakdown as to what my thought process is when looking at the company. And as always, guys, if you guys do enjoy this type of a video, make sure to let me know in the comment section down below. And if you guys haven't already, please make sure to like and subscribe to this channel, because it really means a lot to me and it makes me know that you guys want more of my content. And, if you guys don't like this content, make sure to let me know, throw a dislike down, and, really give me feedback based off of this type of material, because I want to tailor this channel to my viewers, not just for myself. So without further ado, let's get in the video. Now, so as you guys know, I did add Starbucks into my channel's portfolio back in, I believe, October. And, it's been, growing over time. It's up about 30% that it was recorded here in the portfolio. However, you guys know that I was a shareholder in Starbucks prior to creating this portfolio. So I have had shares in Starbucks for just about a little bit over a year now. And when I close out a position in my personal portfolio, if it is a stock that I have added in the channel portfolio, normally I will also close that position. So I just kind of want to reflect it here on this. Again, this is a fake account. You guys, this is just kind of how you guys can kind of see me, go tit for tat on, my opinions on the market and how I position myself accordingly. So obviously this portfolio isn't a 100% representation of what I'm doing, but it does kind of embody what I'm currently doing in the stock market and just not what I have been doing over the past couple of years. So Starbucks was a company that I really enjoyed. I thought the management, was going in the right direction as far as really focusing on China. And I thought that China had the ability to, say double or triple the company's size. So when the stock started to tank, a little bit over a year ago, I really started to buy into my position. That's actually when I started my first position in Starbucks. It was a company that I always kind of was on the fence about. I kind of figured, okay, pretty expensive coffee, it's good coffee, but it's pretty expensive. They are a very national and also global brand. So, they do have kind of a strong, moat around them, I would say. And I really started to see value in the company when it dipped into, the low 50s or the high 40 range. I thought that that was just too cheap for a company like Starbucks with all the potential that they had, say, in Starbucks and other emerging markets. But the company really hasn't been doing things the way I want, so to speak. And, as a investor, as a partial owner of a company, if the thing that you have your own money in line isn't doing what you want it to do, I personally am under the idea that, you guys might know what you're doing, but if it's not something I feel comfortable doing with my own money, I'm just going to take my money out. So as you guys can see here, just doing some quick analysis on Starbucks and their financial statements. Most of this information is taken directly from Morningstar with my own calculations here on the right. So right now, Starbucks' PE is at about a 33. And when you look at a company like Starbucks that's relatively mature, like, yes, they do have amazing growth opportunities in China, and, they are possibly going to be able to grow the company at a very fast rate over the next decade. The fact that you're paying a 33 PE on a company that's EPS growth is sub 20, I think it's even sub 15 right now, it worries me. It means a lot of the growth and a lot of the optimism that the investing community, is expecting is already priced in. And that means that too many people are kind of looking at Starbucks, through, in my opinion, exuberant lenses. So when you look at it, their price to free cash flow is ridiculous. It's at a 9, but that is a bit skewed because that also includes the $8.1 billion sale that they did to Nestle. So, their price to free cash flow will go back to around the 20 range, once kind of, the next year goes out and everything. So their price to free cash flow was definitely nice for this year, but if you look at a long-term perspective and you really understand why that price to free cash flow is so low, that's mainly why, and that's something that, I kind of throw out the window when I'm looking at the company. When you look at the company's current, financial makeup and, what type of money is the makeup of the business and how they're affording all of their acquisitions, their current debt to equity ratio is almost at a 90. I'm sorry, their debt in their debt to equity ratio is almost at 90%, and that is a big red flag to me. Any company that is, touching 80 is when I start to get worried, but a company that is almost 100% debt is something that I don't like, kind of being in, especially when you look at Starbucks being more of the luxury product. So assuming we have a downturn, debt, while it is really fascinating on how quickly it can grow a company and how profitable it can make a company, if a company starts to, not produce sales as well as they have, say if we hit a financial recession, that amount of debt is going to be kind of the Achilles heel for Starbucks. And that's why I'm kind of worried about, Starbucks for the long haul right now. Their Z-score, which for those of you that don't know, is kind of a measure of the short-term profitability and the short-term stability of a company. How likely are they to go into a bankruptcy? After about 3, it means that the company is in good short-term health. So, Starbucks has a Z-score of about 4.44, which means that the company is pretty stable for the short term, but I'm also thinking a couple years out and assuming we have an economic recession, I do not think that Starbucks will be able to really, kind of keep the doors open on all the operations that they have going right now. Their WACC, their weighted average cost of capital, for those of you that use it, this is a very much academic viewpoint on how you analyze a company, so I know a lot of people like to throw that out the window, but if it is something that you're interested in, WACC is essentially, that rate is essentially what the company looks at whenever they go to do an investment project. People will compare it to their WACC and assume like, okay, based off of this and based off the investment they want to do, is it going to give me a higher return on my capital than the company itself? And with a WACC so low, Starbucks is able to kind of throw money at just about anything, and on paper, it is a good investment for the company. However, I think that this has started to make the company really make irrational decisions, and I believe that the reason why their WACC is so low is just to the amount of debt that they've had. They've been doing a lot of financial engineering at the firm, and personally, my kind of opinion on financial engineering is it's great to move the stock price, but if you're looking for long-term wealth, not necessarily short-term income, financial engineering gets very hairy very quickly. You can look at what happened with Kraft Heinz and a couple of other companies that say people at 3G Capital have kind of, financially engineered to all hell, and you see their ROE go through the roof, which I'll get into in just a bit. It means that the company, in my opinion, is better performing on paper than what it actually is. So these are kind of the reasons why I'm looking at the company, and I don't really think that, the company's going in the right direction. I think that, yes, on paper they look stable for right now, but with the amount of debt that the company has in, and also with how low their WACC is, the company's going to look like it's performing much better than it is, and I just do not like that. This ROE over here that I calculated is based off of their average equity over the last 5 years or so, but as we get into kind of the key ratios right here that you can find on Morningstar about Starbucks, is it's not necessarily that low. Having a ROE of 65% almost is outstanding for any business. But when you get down here and you look at what the current return on equity is for Starbucks, you start to see that their equity, surprisingly, ever since around the transitioning period from Johnson and Schultz, you start to see the return on equity skyrocket, and it ballooned from about just about a 50 to currently, over the past 12 months, it's over a 210. And you look at that and you're wondering, how can a company be so profitable and how can their ROE be so high? And that essentially boils down to the amount of debt that the company is taking out. So if you look at, say, what happened with the current assets in the company, and they have a massive spike in cash due to the Nestle deal, and what do they do with that rather than doing anything else? They start to tank their equity because they're buying back shares like crazy, and they start taking out massive amounts of debt in order to kind of finance the rest of the business. So what I wanted to have happen here was, with this Nestle deal, I wanted the company to start really deleveraging, And then, yeah, if they want to give dividends or not, that's fine. But instead of doing, deleveraging and increasing their dividend, they increased their dividend by 33%. And then they packed on mounds of debt and then bought a lot of shares back. So essentially that cash, if you go into, say, just their quarterly report, you see a massive dip in their current assets. So like they had a lot of money due to the Nestle deal, and then they pretty much spent it all right away on share buybacks and dividends. And that made the ROE go crazy, which made everybody see, if like, people that are going pure academic route looking at a company, the ROE is dependent on, how the ROE goes is essentially a representation of how you can expect the stock price to go. So when the ROE goes crazy, the stock price goes like crazy, as we've seen over the past couple of months. But that to me is a big red flag, and it's not something that I really want to be a part of, because to me this screams that, okay, the company isn't getting better, it's financially engineering itself to look better. And then it all kind of boils down to, what they came out with their last earnings report, and, why the stock price moved up, I think it was like 13% or so on the day. And essentially what happened was that the store showed that, okay, we can grow revenues, net revenues up 6%, which is great. I wouldn't pay 33 times the multiple for the earnings of this, but, growing revenue at 9% for a mature company like Starbucks is definitely nothing to sneeze at. However, they kind of boasted, and a lot of the news headlines are talking about that the same store sales growth in the US were up 4%. Now that is a great number. However, when you look into where that growth came from, the customer acquisition and the amount of transactions they had were realistically flat. So that money pretty much came from them using their pricing power. So they showed that they were able to raise prices on drinks. I'm sure any of you that go to Starbucks regularly saw this. Your iced coffee and your regular coffee went up like, say, 20 cents or so. They were able to use that, pricing power to increase their sales, but they didn't have any more people coming in the door. So me, that's kind of a worrisome type of situation, because yes, you can increase sales and you can get more money, assuming you keep the amount of transactions the same, but that isn't a sustainable situation for the long run. And then you look at their China same-store sales, and they're up 1%. Now, China is essentially what Starbucks is betting the farm on. All this extra debt that that Starbucks has kind of had over the past couple of quarters and years has pretty much all been going directly into has all been going directly into pretty much expanding out in China. And they in 2017, 2018 they had a massive expansion in China, but it's starting to worry me. When you look at all of their liabilities kind of skyrocketing, like if you look at their long-term liabilities, it has absolutely ballooned. And a lot of that is a big bet on China, and China isn't really paying off. Now, yes, they do have total sales in China are up 18%, but a lot of that's due to the fact that they just opened up a bunch of sales. So generally, I like to focus on the same store sales growth, because that's really where the real long-lasting growth estimates you can get from. With a food chain, any type of company that has a bunch of individual stores, they can boost their their net sales number very easily by opening a lot of non-profitable stores, but that accounts for more sales. So looking at their same store sales growth over the past year and a half, it's kind of been in between a negative, 0, or a very low positive number. The amount of money that they're betting on China isn't really, turning a profit right now. Now, yes, I do think that a lot of that has to do with the Chinese turbulence in the economy and the fact that competitors like Luckin Coffee have kind of really started to pop up. I do not think that Starbucks is going to lose the coffee game in China by any means. I think that Starbucks has a good enough brand, enough real estate, everything that they were the first to market there, on a large commercial scale. And I definitely think over the long run, they will be fine in China. However, the amount of financial leverage that the company has had if we have a, economic downturn, in the next, 3 years or so, and Starbucks hasn't turned China into a cash cow like it has the US, a lot of that debt is going to come back to bite them. And I think the company was going to have to downsize considerably. Now, obviously, you cannot time a recession, and I'm not saying, that this is the main reason why I'm taking my money out of Starbucks is because of a recession. I definitely think that they are over-leveraged themselves to all hell, and it's dangerous. That is the main reason for it. However, the fact that we could be having a recession over the next couple of years, and that is more likely than not that we will have a recession over the next couple of years, not a guarantee, but just more likely, I definitely think Starbucks will be going through a squeeze during that time, and that is a time that I could probably see myself starting to buy into Starbucks again. But right now, I think the company has taken financial engineering and loading up on cheap debt to kind of the farthest that they could go. They might squeeze it more, which would even add even to a worser possibility for the company. But right now, I think that the majority of the gains that I could possibly see from a company like Starbucks are gone. And now I think Starbucks is becoming more and more of a risky play in my portfolio than what I wanted. So that's why I'm kind of exiting out of it. So as of today, I am out of my Starbucks position. It really hurt me to do that because I do love the company and I do want to hold them for the long term. But I cannot see myself just holding my money in an asset because I like the brand and I'm in love with the company, even though, financially they are extremely risky. I just don't want that to be a thing. And that's why I'm selling out. And, every time I do a sale of a major position, I do like to inform you guys. So that's kind of my overall quick takeaway onto why I am exiting my Starbucks position. Let me know what you guys think in the comment section down below. I know a couple of you are invested in Starbucks, and a couple of you might be looking at this and you might think that the debt level is totally manageable based off of their free cash flow, which is totally fine, and I understand that. But let me know what you guys think in the comment section down below. Do you think that Starbucks is too over leveraged, or do you think that they are fine, based on that, kind of how their business is operating? So thank you guys for watching. Hope you guys got some use out of this video, and I will catch you guys in the next one. Peace.